Welcome to our guide on using vested company stock to strategically pay down your mortgage. Today, we'll explore how you can leverage your RSUs to manage your mortgage effectively, especially when faced with high interest rates. In our agenda today, we will first set the scene with a scenario, then delve into important considerations you need to make. We'll discuss some advice and suggestions, followed by guiding you towards making informed decisions. Let's dive into our scenario. Imagine you are dealing with a mortgage bearing a high interest rate, say 6.225%, with a short tenure of about 5 to 7 years. Meanwhile, you have vested RSUs, and you're considering using them to reduce your monthly mortgage expenses. We need to weigh several factors when using RSUs to pay down your mortgage. First, is the interest rate high enough to justify aggressive payment? Second, analyze market conditions, reflecting on current yields and your risk appetite. Next, think about your company's stock. Are you confident in its long-term success, and should you diversify? Lastly, review your loan's terms, noting aspects like prepayment options, modification costs, and refinancing potential. It's time for a quick quiz. Why should you consider diversifying when using RSUs to pay down your mortgage? Here are your options. A. To minimize risk. B. To buy more company stock. C. To avoid taxes. D. To spend on luxury items. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is A. To minimize risk. Diversifying helps protect your financial interests by spreading your investments across different areas, thereby reducing the risk associated with depending solely on one type of investment. Here are some pieces of advice and suggestions. First, diversifying is crucial, so don't rely solely on company stocks. If you wouldn't purchase the stock with cash, consider selling your RSUs. Think about balancing the joy of reducing your monthly expenses against potential gains from stocks. Lastly, always maintain a substantial emergency fund before embarking on major financial decisions. Now, it's decision time. You need to balance between reducing your mortgage expenses and the potential growth you might see from holding on to your stocks. Consider how aligning these actions match your broader financial goals. To summarize, when dealing with high mortgage rates, using your RSUs can be a smart move. However, always assess market conditions and your confidence in stock performance. Remember, diversify to protect against risks. Before you act, ensure your decisions align with your personal financial goals and maintain an emergency fund. Thank you for watching our video on using vested stock to pay down your mortgage. We hope it provided valuable insights. Don't forget to like, share, and subscribe to our channel. We'd love to hear your thoughts and any experiences you've had with this topic in the comments below.